Are you curious about how the price-to-earnings ratio works? This measurement, commonly called the P/E ratio, gives investors a fast way to judge how a stock is valued. It's one of the most widely used tools for determining whether a company's stock price may be too high or too low compared to its fundamentals. Welcome to FinEd, a channel dedicated to building your financial knowledge so you can become a smarter, more confident investor. If you enjoy clear and practical investing explanations, be sure to subscribe because I release new financial education videos periodically. The P/E ratio is a valuation indicator that compares a company's current share price with the earnings it produces. In simple terms, it shows how much investors are willing to pay today for each dollar of profit the company earns. Essentially, it reflects the premium you're paying to own a portion of that business's earnings. This ratio helps investors gauge whether the market is assigning a relatively high or low value to a stock based on how much profit the company generates. Generally speaking, a stock with a lower P/E ratio, around 10 for example, may suggest the stock is inexpensive. On the other hand, a P/E ratio of 50 or higher can indicate that the stock is priced expensively relative to its earnings. Let's walk through how the P/E ratio is calculated. The formula is straightforward: share price divided by earnings per share. If you're not yet familiar with earnings per share, or EPS, I recommend checking out my dedicated video on that topic for a deeper explanation. When you calculate the P/E ratio, the result is expressed as a multiple, such as 20 times. If you ever hear someone talk about a stock's earnings multiple, they're referring to this exact figure. Now let's look at a simple example. Imagine a fictional company called Riley's Cycle Store. Its stock is trading at $60 per share, and it reports earnings of $3 per share. Dividing $60 by $3 gives us a P/E ratio of 20. What this tells us is that the market is valuing Riley's Cycle Store at 20 times its annual profits. In other words, buying shares of this company means you're paying 20 times what the business earns in a year. Another way to think about this is that, assuming earnings and prices stay the same, it would take about 20 years for the company to generate enough profit to fully repay shareholders for what they paid to buy the stock. The real power of the P/E ratio shows up when you use it to compare companies within the same industry. This allows you to see how the market values similar businesses relative to one another. Let's compare two companies, Riley's Cycle Store and Parker's Mobility Co. Both operate in the personal transportation space, so they can reasonably be considered industry peers. As we already know, Riley's Cycle Store trades at $60 per share with earnings of $3 per share, giving it a P/E ratio of 20. Now let's look at Parker's Mobility Co. Its stock is priced at $75 per share, and it earns $5 per share. At first glance, you might assume Riley stock is the better deal simply because it costs less per share. However, share price alone doesn't tell the whole story. When we calculate Parker's P/E ratio by dividing $75 by $5, we get a multiple of 15. Even though Parker's stock has a higher share price, it actually offers more earnings per share. By comparing these two companies on an equal footing using the P/E ratio, we can see that Parker's Mobility Co. is the better value. Despite its higher price, it delivers greater profitability to shareholders. Paying $15 more per share gives you access to $5 in earnings instead of just $3. That difference in profitability is exactly what the P/E ratio is designed to highlight. This example captures the core idea behind the price-to-earnings ratio. It helps you understand how much profit you're getting for the price you're paying. It's important to remember that the P/E ratio is most effective when comparing companies within the same industry. Different industries naturally have different average P/E levels, so cross-industry comparisons can be misleading. For example, it wouldn't make much sense to compare the P/E ratio of Golden Grill Foods with that of Cloud Nova Technologies. The expectations, growth potential, and risk profiles in the restaurant business are completely different from those in the tech sector. A restaurant company may generate steady profits with slower growth, while a technology firm might have rapidly expanding earnings but greater volatility. Because of these differences, a better comparison would be Cloud Nova Technologies versus another tech firm like Orion Systems. So keep in mind that P/E ratios are most useful when evaluating companies that operate in similar markets and face similar business conditions. Finally, let's look at where you can find a stock's PE ratio without doing the calculations yourself. One of my favorite platforms for stock data is Yahoo Finance, though any reliable financial website will work. If we pull up Amazon on Yahoo Finance and look under the Summary section next to the price chart, we can see the PE ratio listed there. At the moment, it shows a PE ratio of around 34. That means if you were to buy shares today, you'd be paying about 34 times the company's annual earnings. Alright, that wraps up today's breakdown. I'm curious how you use the PE ratio when evaluating stocks. Do you rely on it heavily, or is it just one piece of your analysis? Let me know your approach in the comments. Before you go, I want to share something with you. I've created my own ETF portfolio, and if you like to see how it's performing, I've linked my ETF portfolio down below. If this video helped clarify things, consider liking the video and subscribing to FinEd for more straightforward investing content. Thanks for watching, and I'll see you in the next one.